For more on the impact of the DOJ suit against Apple, we are joined by Satori Fund founder and portfolio manager Dan Niles. Dan, great to see you. First of all, do you have a position in Apple right now?
Yeah, it'll be confusing to your viewers, but we're actually long Apple, but we're short a bunch of their suppliers because we think that Apple's got fundamental issues going forward, and we'd rather attack it through their suppliers right now. We're looking, hopefully, for a bounce in Apple tomorrow, just because I'm sure everybody who's loved this will come out and defend it, and hopefully we get a bounce so we can sell it and short it again. So that's kind of how we're thinking about it from a bigger picture standpoint in terms of our position.
I mean, you don't think that this suit is in any way something to factor in when it comes to your long position in Apple? There are a whole host of other reasons why Apple may have its own issues right now.
Yeah, I mean, so let me be clear about it. We dislike this stock fundamentally. We dislike it over the next year, et cetera. You asked me if I had a position in it. It's complicated, but yeah, we bought it towards the end of the day today. But I think if you sold this because of the DOJ, that makes little sense to me, because we've known this was coming for a while. They've already lost a lawsuit against Epic in Europe. The App Store rates have already come down. If you are selling it because it's a bad chart, totally understand. If you're selling it because the fundamentals have been poor for a year now, and it's catching up with the stock, and estimates have been coming down for a year now, totally get that. But if you're selling it off this DOJ thing, which is going to take years to sort out, that makes no sense. And with the 2 standard deviation move lower, we're like, we'll buy it for a trade and rent it, and hopefully if it goes up tomorrow, we'll sell it and short it again.
Strategically, you've been trading from the short side well, by the way. As Tim said, it's underperformed for quite some time. So understanding you're going to look for entry levels and exit levels, what's your ultimate price target on the downside, where if it got there, you're like, okay, this is an entry point for now, being on the long side and trading around a long position?
So here's the way I think about it. From a long-term perspective, this stock should have a below-market multiple. The revenues have not, if you look at what they guided to for the March quarter, they're almost the exact same number as 3 years ago. They have competition issues with Huawei coming back. They don't need U.S. chips to make smartphones anymore. And so I look at it trading at a 25 PE versus the S&P at a 22 PE, with hardware companies in the PC ecosystem, for example, trading, in the low double digits. And so I look at this and I say it deserves less than a market multiple, given especially that their high margin revenue stream in services is under attack as well. So from the short side, from a long-term view and a fundamental view, it's nowhere near where I would think this is a fundamental long.
Hey, Dan, it's Tim. Thanks for joining us. In terms of the market's not a zero-sum game, but we often talk about Apple as being such a critical stock for the market. Do you think Apple's weakness actually could be positive for the market? I know this sounds obtuse, but to the extent that we're seeing broader allocation, Apple certainly derives a lot of passive flows, but it also certainly has folks that will be allocating this money to other places that they can find. Again, what is Apple for people? Yeah, it's a market proxy. It's a market weight, but it's maybe consumer staples. Maybe it's consumer discretionary. Just thoughts on the bigger picture of Apple's role in the market.
I think you're 100% right, Tim. I mean, markets are never good when they go straight down based on the Fed, and then they go straight up based on the Fed. And you can look at the last 2 years, that's the situation, right? Magnificent Seven down 46% in 2022. Then they're up 111% in 2023. Why? The Fed had the fastest rate hikes in history in 22. They stopped in 23, and people were at one point looking for 7 rate cuts. Right now, the market's actually really healthy, because Tesla stock's down 30%. Estimates were coming down for a year. Apple estimates have been coming down for a year, but the stock was up 48% last year. This year, however, you've got Apple down 10%. You've got Tesla down 30%. And which stocks are performing the best? Well, the ones that took up numbers the most. NVIDIA up 80%, Meta up another 40%, and then you got Microsoft and Google and the others kind of in the middle. So the market is reacting to fundamentals the way it should versus some pipe dream about, augmented reality is going to be great a decade from now or something like that. This is actually a healthy market. And to your point, the money is finding its ways into other areas. We own several industrial stocks that we like. We own some financials that we like. We own some biotech. And you're seeing the market broadening. And I think that's super healthy, whether you're talking about it coming out of Apple or Tesla, or you pick your favorite name.